So this video is for the new specification for AQA GCSE Business Studies, and it's the Finance Unit, Unit 6 on income statements. So what we'll do in this video is just quickly look at how to calculate an income statement. Now, as you can see within the table, this is pretty much the general layout of an income statement. So you got your revenue, you got your cost of sales, and that allows you to calculate your gross profit. Then you got your overheads, and finally your profit. So what an income statement does, it does allow you to calculate your profit or potentially even loss for a company, and it helps you to break down the costs to see which one is maybe having the biggest impact on that ability to achieve profit. So the first factor you need to consider is of course revenue, and revenue is the income from selling the goods or the services. But what the income statement really looks at is in terms of the cost of sales and the overheads, and it's the impact of costs on that revenue. So what I mean by cost of sales is very similar to your total variable costs. So it's in terms of the costs which directly relate towards your output. So it could be packaging, it could be stock, it could be raw materials, it could be any kind of component that goes towards producing the product. Once you've worked out what your revenue is, and once you know your cost of sales, then what you can do is start to calculate your gross profit. Now, the simple formula for gross profit is your revenue minus your cost of goods sold. So as we can see in January, the revenue is 500,000, your cost of sales is 100,000, so therefore their gross profit is 400,000. In February, again, 590 grand minus 120,000, you got 470,000, and finally March, 610,000 minus your 125,000 equals your 485,000. Now, once you've calculated that, what you can do is then you can start putting into percentages in terms of gross profit margins, and that just pretty much tells you, I suppose, how efficient you are at turning that revenue into your gross profit, and what impact your cost of sales is having on your revenue when trying to achieve those profits. So I'm going to kind of quickly show you how to do that calculation. So I've done January for you. You've got your 400,000, which is your gross profit, divided by your sales revenue of 500,000. That'll get you 0.8, times it by 100 to get a percentage, and that is 80%. Now, to say if that's high or not, you'd have to compare it to something. So for example, you could compare it to other companies if you had that information, or you could compare it to different months. So let's have a look at February and let's have a look at March, and we can compare the 3 months and see if they get better or get worse. So in February, you can see that you get your 470,000 for your gross profit divided by your 590,000, and you'll get 0.7966 around it, and we get 79.7%. So even though their gross profit has increased and their revenues increased, but their cost of sales have also increased. Now, it's only a slight dip, but it just means that efficiency of turning revenue into gross profit is slightly dipping from the month before, but to be honest, there's not much difference. Now, once you've worked out your gross profit and your gross profit margins, it doesn't tell you everything. It doesn't give you a whole understanding of profit because you haven't considered the overheads. Now, another term for overhead is expenditure, but it's very similar to your fixed costs. So it's based on those costs that you have to pay regardless of output. So for example, your advertising, your rent, your insurances, and so on. So once you've got that, now you can work out your profit. So you'd get your gross profit and you'd minus your expenses, or you minus your overheads. So as you can see here, 400,000 minus your overheads of January of 200,000, and you get £200,000. In February, you can see your gross profit of 470,000, again minus your 200,000, and you get 270,000, and so on. And after that, again, you can turn it into a percentage, and you can look at the margins. So you just get your net profit or your profit divided by your sales revenue and times it by 100 to get a percentage, and it gives you an idea of, again, how efficient are they at turning that revenue into profit. Now, you'd usually expect that your profit margins and your net profits would be lower than your gross profit because obviously you got your overheads. But it does give you an idea as to how much they're paying on different types of costs. So for example, are their cost of sales too much at this point in time? Are their overheads becoming excessive? And it might give them ideas of strategies on how to improve their profits. So we can see here you get your 200,000, divide it by your revenue of 500,000, and you've got a profit margin of 40%. Now, obviously, 40% is quite a bit lower than the gross profit margin of 80%. So straight away, you could say maybe there's overheads. If we wanted to boost profits and we wanted to think of ways other than increasing revenue then one way maybe is to aim it at those overheads and try to reduce those overheads.